Welcome to this third episode of The Next Decade. Today, we sit down with Laurent Lequeu, financial consultant, macroeconomic strategist, and author of the Macro Butler newsletter for an in-depth conversation covering East versus West political and economic directions, how Hong Kong may become the center of the economic and financial world. We also dive into stagflation risks, the disruptive role of Donald Trump, a potential anti-Western alignment between Russia, India, and China, Europe's bleak economic future, the US-China trade war, manufacturing, energy, gold, Bitcoin, and much more. If you enjoyed this conversation, don't forget to like, subscribe, and leave a comment to join the conversation. Let's jump right in. Today, our guest is Laurent Lequeu, financial consultant and the man behind the global Macroeconomic Analysis Substack newsletter called the Macro Butler. Laurent has also managed funds, given investment and financial advice to multiple institutional funds, high net worth individuals, as well as retail investors. Laurent, welcome.
Hi, Philippe. It's my pleasure to be on the Next Decade show.
Pleasure to have you on the show. Let's start with something a bit more personal before we get to the profound stuff about geopolitics and geoeconomics. You've been living in Asia for over a decade now. I think the West is not fully aware of how the East perceives it. So how is Western politics perceived from an Eastern perspective?
Well, there's an old saying in Chinese: when you are clowns, you end with a circus. So I think that this fits quite well for a lot of Western governments nowadays. I mean, not only the current US administration, but as well many governments in Western Europe. And this clearly show the big divide that we have seen over the years between East and West. In the East, whatever newspaper and media can say, governments are still focused on spreading prosperity for their own citizens, while on the West, clearly governments are focused on their own interest and have been driven by a policy which I would say is more like a globalist policy, and all these policies related to climate change, which at the end of the day have contributed to the decline of the Western economies.
All right. Talk to us a bit about you. How did you end up in macroeconomic analysis?
Well, I study finance in Brussels, and then after around 8 years spent in multiple jobs in Luxembourg, I decided to move to Asia, and I settled down in Singapore in 2012. So it's almost 13 years that I've been in Asia, where I've done all kind of works around private banking, high net worth individual advice among family office. And then in November 2023, I decided to fly on my own to create the Macro Butler newsletter, as well as to launch a personal financial service. As I've seen the need for high net worth individual for an independent advice, which is not being served by private banks as well as by my multifamily office.
And how do you go about analyzing the macroeconomic world? What data points, narrative, any other data points that you think are relevant that you're looking for to make up your view of the macroeconomic world that we're in?
Well, I think that it's important that everyone understand that we are all connected and everything is connected. So from the economy, from geopolitics, from political decision, as well as even the climate. So I'm a big believer in cycles, and I think that's what I've learned being in Asia for more than a decade is everything move in cycle. So we have the business cycle, we have the climate cycle, we have the war cycle. So to make it a long story short, for analyzing the business cycle, I mostly focus on market data because I don't trust government data. So I think that very simple market ratio, like the S&P to oil ratio, the S&P to gold ratio, and the gold to bond ratio give investor a state of the business cycle. And based on this analysis, in fact, investor can invest their portfolio across the four major asset classes that are available to them, meaning cash, bonds, equity, and gold. So I try to keep it simple, both in terms of the study of the business cycle as well as in terms of asset allocation, because at the end of the day, what I also learn over my experience in financial market is that investors should focus more on managing risk by limiting the drawdowns rather than hoping for upside potential. And I've noticed that professional investor as well as retail investor are never focused enough on risk management and are too much focused on trying to catch the next good tip in the stock market.
Are we in a risk on or risk off world right now in the last few weeks?
Well, if I go back to this analysis of the business cycle, and I focus on the US because the US is still the leading economy in the world. I mean, the US economy is still in the inflationary boom, meaning that we still have the S&P to oil ratio above the 7-year moving average, but the gold to bond ratio is also above the 7-year moving average. So over the, I would say, a long-term time horizon, we are still in a risk-on environment, even that clearly nothing is going up one straight line. So, I mean, there is volatility along the way. And I guess that the introduction of tariff, the arrival of the disruptor in chief at the White House have clearly increased the volatility in financial markets. But as an investor, we all have to adapt to the circumstances of financial markets and the environment. That's what our clients ask us to do, is to adapt and invest according to the environment. So I would, to cut a long story short, we are still in a risk-on environment, but the risk is that the US move into an inflationary bust because the policies that have been implemented over the past few weeks. And clearly, I mean, in a shorter way of telling the world, an inflationary bust is a stagflation. So stagflation is a very challenging environment for investor to deliver sustainable return. But we are not there yet for the time being, and it's still a question of when the US will shift in this inflationary bust.
Can you define what stagflation would be?
Well, stagflation, for the older of us who can remember, is the 1970s kind of environment where you have weak economic growth or negative economic growth and higher inflation. So basically, according to the way that I see the world, stagflation is an environment where corporates are not able to deliver positive earnings growth, and we have a kind of rampant inflation environment. So for investor, if we look back at previous stagflationary environment, and in fact we had such an environment in 2022, and I think that this will be a better way for investor to remember what happened in 2022. In 2022, we had a declining stock market. We had government bonds and the fixed income asset class declining at the same time, and we had only gold as a safe haven. So if we are moving into a stagflation that could last longer than it lasts between 2022 and 2023, I guess that this is another tailwind for the gold price. And for investor, it would mean that they will have to be much more focused on what they buy among stocks and how they allocate their portfolio across the antifragile asset, which at the end of the day is only gold.
You've mentioned Donald Trump as the disruptor in chief. Why do you say that?
Well, I mean, it's quite clear that he came to the White House for his second term to disrupt the global world order. I mean, he disrupted the way that the world has been trading over the past 50 or 60 years. He also tried to disrupt the geopolitical order. I mean, he's desperately trying to settle a peace agreement in Russia, between Russia and Ukraine. But I think that he has a bigger view of the problem. And what happened since 2022 is that the conflict between Ukraine and Russia has pushed Russia in the arms of China. And in fact, this has kind of created axis of Russia, China, and ultimately India. We can discuss later on that matter if you are interested. But what Donald Trump tried to do since he has been back in the White House is to break the Russia-China relationship, which is much more harmful for the US than any kind of other geopolitical relationship.
Let's talk about it right now. How do you see the triangle between Russia, India, and China evolve? Because off the top of my head, I'm thinking about it. Russia, China kind of makes sense, but India doesn't like China at all. They're almost in constant war with them over a border dispute. How would the three ever merge into, I want to say, one coherent economic force?
Well, I think that here, first, you must remember that in 2022, US dollar asset from Russian investor has been frozen. Mm-hmm. So this has kind of, I mean, this weaponization of US dollar asset has created a new trading system in the East, allowing countries to buy Russian oil in other currency than the US dollar. So it's right that China and India have been in geopolitical tension for decades, as the same was true in the past between Russia and China, by the way. But the war in Ukraine and the weaponization of US dollar asset have quite of changed the situation, because, I mean, Russia couldn't and still cannot sell its oil in US dollars. So what Russia has done since 2022 is that it allowed China and India to buy Russian oil in local currency. And for India, if you look at the past, I mean, India economical situation has always worsened when the oil price spikes, because India is a structural oil importer. And by giving India the ability to pay for its Russian oil in rupee and to get a discount on the Russian oil versus the oil price in international market, I think that clearly Russia has opened a door to create this triangle, which is based on very simple facts. You have Russia, where there is abundant and cheap sources of energy and commodities. You have China, which is a state-of-the-art manufacturing powerhouse. And then you have India, which is the new consumer market in the world. the demographic in India is still very favorable to boost consumption. And so India is in need of cheap goods and cheap energy, and it can find these cheap goods and cheap energy and cheap commodity with aligning with Russia and China.
Interesting. Let's skip to Europe. You've been very pessimistic about Europe's economic fate, I should say, sorry, even calling on people to withdraw their money from the continent. Why is that?
Well, I mean, if you look at the state of government debt and the economy in general in Europe, it's difficult to see any sign of positiveness in any country of the Eurozone as well as the UK. So the reason that my pessimism is that, again, I go back to this major event in 2022. The Russia-Ukraine war has also been the start of the decline of the German manufacturing business model. Because the German manufacturing business model was based on the access to cheap energy from Russia. We all know that with Nord Stream and everything that happened since 2022, it's not possible anymore for Germany and other European countries to get access to cheap energy from Russia. And this has been the start of the decline of the Eurozone, which was already, I would say, in a bad shape financially. Why I advise any investor to move out their asset out of Europe is because I don't see any other solution outside the imposition of capital control in Europe, and this will come sooner, much sooner than later. In fact, I think that would we see an escalation in the conflict in Eastern Europe over the next few months, you could easily see France and the Eurozone as well as UK imposing a capital control. And when capital controls are imposed, it's impossible to get out of a country or of a region. So, I mean, especially since it seems to me that the next phase of the war cycle will come in Eastern Europe, I wouldn't like to have any investment in the region.
What would capital control imply in Europe, if ever applied? What would that mean concretely for savers and investors?
Oh, I think that, I already hear in France that the government is looking to use some of the extra savings of every investor to finance the war project or this project of increasing defense spending. So, I mean, this is the first example. Probably, I mean, I'm not in the secret of the French government, of any government, but it would mean that anyone who has more than, let's say, 100,000 euro on his saving accounts will have to invest the balance of this in a war bonds or in a government bonds that is used to build the defense system in Europe. It would mean, and I refer to recent history. I mean, the best example of recent history in terms of capital control is what we have seen in ASEAN countries around the Asian financial crisis. I mean, this will inevitably mean a decline of the currency, meaning the euro. And whatever people can say today that the euro is rising against the dollar, in fact, this is to me a false flag because the euro will plummet in terms of its value against other currency, against the US dollar, and of course against gold if capital controls are implemented. I guess why I also think that capital controls are coming sooner rather than later in Europe is because the ECB seems to be in pole position to implement the Euro CBDC. And clearly, you don't need to be an expert to understand that a CBDC is the easiest way to implement capital control. So I guess that we will see this. This is unfortunate for Europe, but it's still time for European investors to get out.
Is there any hope for Europe?
Well, to be honest, the only hope for Europe would be to make a U-turn and to go back into an alliance with Russia, because Europe has no natural resources. Europe has no cheap sources of energy, and the only hope for Europe would be to make an alliance again with Russia, to get access to cheap energy from Russia. And also, the hope for Europe is to get rid of all this bureaucracy, which is kind of limiting entrepreneurship everywhere in Europe. I would think that the best hope for Europe would be that a leader in one of the major countries, would it be Germany or France or Italy, decide to exit the European Union. And it would mean the end of the European Union. And because at the end of the day, like it or not, the problems are all the bureaucrats in Brussels, which are not contributing to economic growth.
Interesting. Let's go back to China, US. It's difficult to avoid talking about the trade war that's taking place right now. How do you see the whole thing play out with Trump's tariffs in place or about to be put in place against China, and China's rhetoric, which seems not to want to back down at all? How is the trade war going to evolve in your eyes?
Well, the situation is very fluid, so I will timestamp my reply. Is 23rd of April, is 10:35 a.m. Singapore time. So as of now, I would think that we are in a standstill. But would the current tariff stay in place? Clearly, what we will see is that we will see that a lot of goods which are imported from China into the US will disappear from the shelves. And the issue for the US is that many of these goods have no replacement. This will inevitably create shortages. This will put in a lot of sectors like construction into trouble. The construction industry in the US is a very big industry in terms of employment, and it's highly dependent on supply goods from China. So if there are no more goods available for the construction sector in the US over the next few weeks or months, I would think this will create a situation where you will see a lot of job lost in this sector. And everyone must remember that the people who work in the construction sector are the most MAGA among all, right? So I guess this will probably put pressure on Donald Trump to find a way to start a negotiation. I think that the way that the U.S. administration has dealt with China has been the wrong way. You don't confront China publicly like you can do it with Mexico or with another country. It's all about the art of the trade, or the art of the deal in Asia, where people cannot lose face. So we need the US need to find a solution one way or the other. Also, I would think that the goal of the tariff at the end of the day is for foreign investor to bring back manufacturing capabilities into the US. if you create an environment in the US where the rule of law cannot be trusted, I don't think that a lot of foreign entrepreneurs are going to come back into the US to build a multi-million plans. And so I think that the most important over the next few weeks is for the US government to assure that the rule of law in the US is still the rule of law that we have known over the past decades. And this means that the law or the rule of law cannot change every 30 minutes by using a tweet on Truth Social. I mean, we have to be honest here. If you are an entrepreneur, you are going to commit an investment of, let's say, 10 million US dollar to build a manufacturing plant in Montana. You are not going to, you don't want to see the rules changing every 30 minutes. And so I think that the US needs to give all investors, not only Chinese investors, the certainty that they are still welcome to build things in the US. And I think at the end of the day, the 47 US president is a businessman, so I guess he will understand this over the next few weeks. But I gave a very long answer to this question. I would think that what the US also and the Western world must understand is that Chinese export to the US is around 14 to 16% of total Chinese export. It means that more than 80% of Chinese export are done outside the US. And so the US is not anymore the key market for China. And at the end of the day, if there's no change in terms of the tariff policy, what does it mean? It means that this alliance between Russia, China, and India will strengthen after this tariff story. And China will probably come to other countries in ASEAN or elsewhere in the global south, in Africa or Latin America, and will find a way to sell its goods. It's this 14% of export will find their way elsewhere in the world, and the US will end with no supply because there's no alternative. There's no made in USA alternative to most of these goods.
So do you think that Trump, well, I get the feeling that you're arguing that Trump won't succeed in reindustrializing the US.
Well, it depends. I would say if he can give a carrot to investor for reindustrializing the US, it's possible. But what we have seen since Liberation Day is mostly a stick and rather than a carrot, right? So I would think that to be successful in the reindustrialization of the US, you have to give some carrots to international investor, and of course he has to give even more carrots to the Chinese, because it seems to me that if I was BYD today, I don't think I would commit to build a car plant in Detroit because I can hand Russian investor, and it after 2022, my asset can be frozen and confiscated. So until the 47 US president cannot give the assurance that everyone is welcome to reindustrialize the US, I think that this plan is on hold.
If you had to bet or invest money in a country and that money stays there for 10 years, which would it be right now?
Well, I won't choose one country specifically. I think that over the next decade, we will see an economic boom in what is called the Valéry-Pierre circle. So this is a circle of around 2,000 miles with a center around Hong Kong. And so this includes Russia, China, India, and all ASEAN. So for investors who have a 10-year time horizon, they should start invest in this circle, in this Valéry-Pierre circle, which comprise, I would say, which is built around this alliance between Russia, China, and India.
And you've mentioned also that the financial center of the world might shift from New York to Hong Kong in the next few years. How so? How would that happen?
Well, I think this is related to this economic boom that is coming in the Asian region. I would think that, again, if I take a step back, one of the main consequences of the impact of the Russian-Ukraine war and the weaponization of US dollar assets is that foreign investor, I mean non-US investor, cannot really trust anymore US institution for their economic development. So especially Asian investor will need to find a new financial center to, I would say, fuel this economic boom in the region. And Hong Kong is, I would say, the obvious place to be this location, because Hong Kong has an history of using the Anglo-Saxon law. I mean, it's still an English, English-spoken country, and it's on the border of China. And Hong Kong is kind of used as the city-state by Chinese investor to invest in the region and still across the world. On top of this, the HKMA has a massive US dollar reserve, so they could spend use this US dollar reserve and spend them to help to this economic boom. So it seems obvious to me that Hong Kong is the next New York. I mean, probably Shanghai will do very well as well. But Hong Kong will be the place where East and West meet in terms of financial relationship.
Earlier this year, you made 10 bold predictions on your Substack, the Macro Butler. One of them is that you anticipate there will be a proxy war that would erupt in the Korean Peninsula between NATO and the global South. Can you explain the scenario you had in your head when you thought about that?
Well, I mean, if you have followed the news over the past few weeks, the Ukrainian government has accused North Korea and even China to supply weapons to Russia. So again, I would say some in the Western world are desperate to create more wars because their economic situation is in a dire strait. So they need to create enemies to rally their population across around a flag. And Korea looks a good place to start a new war because I mean, the South Korean government has been in a lot of trouble over the past few months. You may remember last year military kind of intervention when the martial law was declared by the former South Korean president. So I guess it's quite an easy place to trigger a false flag. And this will also bring potentially China into a conflict with the West. As I said, I've been living here in Asia for more than a decade, and I don't think that, at the contrary of what people in the Western media say, Asians are not interested in wars. Asians are interested in creating prosperity. In particular, Chinese have a long tradition of being merchant. Indians also have a long tradition of being merchant across the centuries. So what matters for Asia is to sell, trade goods, manufacture goods with others, and they don't really care if your government is white, blue, red, or dark purple. Meaning that they are not interventionists like the US has been or the West has been after the Second World War. The Asians are in for a good trade relationship, and the way every government manage their own business is their own business, unless on the other side of the coin. I mean, we know that European government and the US government has historically tried to impose its way I would say, its way of life to the rest of the world. This has not been the case from Asian in history.
You talk about energy, going as far as saying that investors should think about shifting their investments from energy consuming sectors such as IT to energy producing sectors such as oil. Namely, what's the big picture when we think about energy going to the next decade? What should we keep in mind? What should we know? What's going to happen essentially?
Well, I think that I mean, like for everything, it's a story of supply and demand. And even that on the demand side, economic growth will most likely be limited because of all the tariff and whatever can be imposed. I would think that the story of energy is mostly a supply story. Investment have been constrained over the past few years by all the ESG regulation. Even in the US, I mean, when Donald Trump was elected, there was a big scare that the US will drill, baby drill, and this will impact oil prices. I mean, let's be honest, there's very limited capacity for the US to significantly increase its oil production in the near future. So on the supply side, on top of this, if you have a geopolitical accident in the Middle East, I mean, this will impact the supply side of the equation. So the supply is very constrained. And on the other hand, if we move towards the reindustrialization of the US and increasing automation and increasing use of AI in US industry, the US will need increasingly more energy. So I can only see a positive outlook for the energy sector from here. On top of that, the energy sector is still unloved by most investors. It's under-owned. Nobody owns any oil and gas company, and it's less than 3% of the S&P 500, meaning that all the indexed investors don't really need to have a look at it. On the other hand, you have IT being more than 27% or almost 30% of the S&P 500. So every index passive investor own too much energy consumer and too little energy producer.
Interesting. Very few people talking about that right now. Global economics have been on a roller coaster the last few years, but we went from a COVID-induced market crash to high inflation to markets breaking all-time highs to sustain the fears of global recession without any recession, at least not so far, to the current trade war between the US and China. How do you see global economics evolve in 2025 and beyond? Do we actually get a recession at some point? Or do we solve the massive public debt problem, which is global? Where are we heading, essentially?
Well, I would think that if these tariff policies are here to stay, I mean, historically, tariffs are stagflationary. So once again, we will see much weaker economic growth and much higher inflation. And this will be the case across the world. Some countries will be affected more than others. I would think that the next problem is still that the confidence that investors have in the governments. And I think on that level, the investor confidence in governments is declining. In Europe, it's already very low. In the US, it's also declining because, I mean, as I said, the policy seems to be done around a tweet on Truth Social, which is not really a good sign for giving confidence to investor. So I would think that all in all, and with the weaponization of US dollar assets, you have seen the emergence of gold, of physical gold, which the price has been rising in all currencies across the world, from Chinese yuan to euro to Canadian dollars or to US dollar. And in fact, this is the sign that investors are not giving a lot of confidence in government asset like government bonds and are replacing their allocation from bonds into physical gold. And so to come back, yes, we will see slower economic growth. We will see probably much stickier inflation, and also going back to the 1970s. I mean, if there's one asset which is doing well in such an environment, it's physical gold. So, like for the rest, you may have some blip in the bull market, but it's fair to say that at $3,500 an ounce is just a start for physical gold. Again, I also want to say that, and in an environment where investors are losing confidence in the governments, some of the assets will have to be redirected to the private sector. And that's why, in fact, I think that we will see new high in the Dow Jones in the next 12 to 24 or 36 months, meaning that it's still better for many investors to hold a share of Walmart rather than holding a US 10-year bond. And you will see a lot of flow from one asset class to the others, and the amount that are invested in fixed income are almost 5 to 10-fold the amount that are invested currently in stocks and gold. So even if you have half of these flows shifting from bonds to gold and equities, you will see tremendous divergence of performance between asset class.
So we should expect interest rates, at least when it comes to the 10-year bond in US or 30-year bond, to go up?
Well, I think that it's fair to say that it's unlikely we see the 10-year yield going back below 4% anytime soon. I mean, we have seen also during the past few days that the US Treasury bond is no more a safe haven in times of tantrum in financial markets. So I think that we will see structurally higher yield in the US. I'm not telling here people that we will see double digit on the US 10-year yields soon, because you will still have some inflows, especially you will have geographical inflows from Europe into the US, and some of these flows will find a way to the bond market. But if you are an investor, as I said, you are better to hold a share of the Dow Jones than to hold government bonds, because if we are in this environment of sticky and kind of rising inflation, I mean, you are better protected by owning stocks rather than bonds. I mean, this is 101 finance.
So Trump's open desire to lower rates will fail, most likely.
Well, to be honest, there's a caveat to what I just say. I mean, there's always the possibility for the Fed to come to the rescue of President Trump and to restart a QE, which will be renamed not quantitative easing, but which will be renamed otherwise, because QE has a bad marketing connotation. But I mean, there's also a potential possibility for the Fed to implement yield curve control. I mean, Japan has been implementing yield curve control for many years, and this has allowed the 10-year Japanese government bonds to be near zero for many years. So you can never underestimate what the creativity of the central bank and the Fed. And I think, in fact, that all this feud between Powell and Trump is kind of a sideshow, because Powell can easily help Trump by re-implementing quantitative easing, which will keep the 10-year yield in check and the 30-year yield in check. And at the end of the day, for the Americans, that's what matters, because the mortgage rate, the car loan rate is indexed to the 30-year bond yield. So the Fed fund rate is completely irrelevant. What matters is what the Fed will do with the long end of the curve. On top of this, I mean, if the Fed restart a QE, I mean, this will also ease the job of Scott Bessent to refinance his $8 trillion until the end of the year. So there's a kind of a win-win situation here that I can see with the Fed helping Bessent and Trump economically and financially by starting QE, or by restarting shadow liquidity injection like we had during the bank run around SVB.
Last question. I think I know the answer, or at least I think I know your answer. But if you had to invest $1 million in gold or in Bitcoin for the next 10 years, which would it be?
Well, I don't believe in Bitcoin at all. To me, is at best a speculative trading tool. At worst, it was created as an appetizer to the CBDC. So I would think that 1 ounce of gold will always be worth 1 ounce of gold, and you can go across the world from Shanghai to Singapore to London to New York or Vancouver, and you will still have 1 ounce of gold in your pocket. And across centuries, this has been the only antifragile asset with no counterparty risk, and it remains the only antifragile asset with no counterparty risk.
Interesting. Laurent Lequeu, final words?
Thanks for your interesting questions, and I hope this has been eye-opener for many of your viewers. And if I can do a bit of marketing, anyone who want to read about the Macro Butler can Google the Macro Butler. I'm on Substack, and anyone who wants to be in contact with me can send me an email at info@themacrobutler.com. I reply to all email, and I'm always interested to speak with everyone from all over the world, because that's the best way to get the best opinion on everything. And I wish your viewers to be healthy and wealthy, and stay calm and happy investing.
You're also active on LinkedIn, am I wrong?
That's right, I'm also active on LinkedIn as well as on X.
Perfect. All right, so X, LinkedIn, and the Macro Butler on Substack to follow Laurent Lequeu. Once again, thank you very much.
Merci.